Good morning, one and all. I am Ashwin Nandikesh S of 3rd BA Applied Economics, and today I am here to talk about the basics of taxes. This PPT was created by me and Melvin David of our class. Now, let us begin. First of all, these are different topics we're going to learn today. The contents. Now, what are taxes? Types of taxes, direct taxes, indirect taxes, and tax incidents. Direct tax and indirect taxes are the two main types of taxes. We'll go into that in more detail in the next few slides. Now, what are taxes? Taxes are basically the remuneration of fees or rent, whatever you may call it, collected by our country for various government expenses as well as for creating various government facilities, infrastructure, and for various other expenses such as army, policing, etc., to keep the safety and security of our country. Now, these taxes are collected from each person or each citizen living in a country via various methods. Such as it can be via your income tax, via various sales tax, via GST, etc. Now, let us look into different types of taxes. There are two main types of taxes. These two main types of taxes are direct taxes and indirect taxes. Direct taxes are taxes that are levied directly from a person or individual or from a group of people. They are examples of direct taxes are income tax, wealth tax, etc. Indirect taxes are taxes that are levied indirectly from people. Examples of indirect taxes are UPI transaction taxes or other sorts of transaction taxes. Now, let us look at the different types of direct and indirect taxes. The different types of direct taxes are income tax, capital gains tax, securities transaction tax, perquisite tax, and corporate tax. Now, let's have a detailed look at the different types of taxes. First of all, income tax. In different types of direct taxes. First of all, income tax. Income tax is such a tax that is imposed upon your taxable income in the fiscal year. There are a lot of facets or different deductions, additions, etc. to income tax, such as taxable income, reduction of taxable income, tax slabs, deducted at source, etc. Now, this tax is pertinent to both companies and individuals. For individuals, the amount they pay against a tax is based upon the tax bracket they breathe in or the tax slab they breathe in. This slab or tax decides that, as I was saying, this slab or tax decides how much a certain individual has to pay. Now, a tax slab or tax bracket is basically based upon your income level. That is, if you have an income level of below a certain amount, that is, if you're a low income individual, then you only have to pay a certain amount of tax. And if you're a income individual, you have to pay more. Now, the maximum amount of tax induced in some countries is 30%, and it differs according to different countries. Now, let's look at the next type of tax or next type of direct tax, which is capital gains tax. The capital gains tax is payable whenever you get a considerable amount of money. It could be from the sale of a property or from an investment. That is, there are generally two types of capital gains tax. That is long-term capital gains tax and short-term capital gains tax. Now, long-term capital gains tax is made as tax from an investment that is real estate, etc., that is made from over a period of 36 months, and short-term capital gains tax is from investments made for more than 36 months, for not more than 36 months. Now, 36 months, that is 3 years. This tax is applicable for each individual, each of these, and there's also different let's see, slabs for short-term capital gains tax, similar to income tax. That is, suppose you're a low income earner, then your short-term capital gains tax will be lower. If you're a high income earner, your short-term capital gains tax will be higher. And for in certain countries, the long-term capital gains tax is limited at 20%. The third type of direct tax is securities tax or securities transaction tax. This tax is levied basically when you trade shares, securities, bonds, etc., and the tax amount base is based upon the share's price as well as the amount of money you gain from selling the security. That's all we have to learn about securities tax. Next, let's go into perquisite tax or perquisite tax. A perquisite tax is taxes that are levied upon the various benefits that an employee gets when working at a company. Suppose when you work at a company, you get various perks such as you get a car, you get a house, you get health insurance, etc. Now, suppose one of these perks is the car, and the tax levied upon the car will be deferred upon what you use it and how the company acquired it, etc. If you use the car for official purposes as well as personal purposes, then only the amount of time you use it for personal purposes can be taxed, as the rest will be given to is taxed for the company as it's for official purpose and cannot be taxed. Next, the next type of tax we have is corporate tax. The corporate tax is income tax for a company, and it is paid by the revenue earned in a year. The corporate tax is also has its own slab system that depends. If the company is a high earner, it has a higher amount of corporate tax. If it's a low earner, it has a lower amount of corporate tax, etc. The company's income is treated separately from the shareholders' dividend under the corporate tax and is levied by domestic companies as well as foreign companies. Thank you. Next, let's go on to indirect taxes. The different types of indirect taxes are sales tax, service tax, value-added tax, customs duty and octroi, and excise duty. Now, let us have a look in detail. Sales tax is those taxes that are applied on various products when they are sold. The sales tax is usually imposed upon the seller when they sell an item, which the seller passes on to the buyer as an added amount or summated amount to the price. As I was saying, sorry for the interruption, sales tax is basically tax that is levied upon the seller, which the seller passes on to the buyer by adding it to the price of an object. Now, the thing about sales tax is that it can only be levied once. That is, if I buy a certain item from a store, like I buy a pen from a store, sales tax of the pen is applied already in the price, and I pay it. Now, when I resell the pen, I cannot apply sales tax to it, as it is as I do not have to pay sales tax. This is all about sales tax. Next, let's go into service tax. Now, service tax is those taxes that are imposed upon various services that we receive from a company. Suppose if it is a restaurant, then the then service tax is included in the price of the food you buy. Now, since service taxes cannot be pinpointed in an organization, since there are many different types of people working there to achieve the final end result, each company or each type of company has their own percentage of service tax. Certain companies are 12%, certain companies are 14%. The annual or quarterly service tax to be paid by restaurants is 40%. That is 40% of the total income, based upon the different levels of service they provide, such as cooking, waiting, cleaning the tables, etc. Basically, service tax is this similar to sales tax, but it is tax applied on the various services that are done for us, such as waiting, serving, etc. Now, next let's go on to value-added tax. Value-added taxes are certain taxes that are applied along the various steps of production of a product. For example, in the process of making bread, each step, that is, when the farmer sells it to the let's see, the mill, then the tax for the value of the work of farmer is applied there. Afterwards, when the mill turns into flour and sells it to the baker, another value is added to the value added tax, and when the baker sells the bread, finally his value is added to value added tax. Value added tax is not imposed on commodities, it is imposed on every step of the way. And not many states or countries apply value added tax nowadays, but it is still done throughout the world. It is basically done to take into consideration all the different elements that go into making a product, as well as to try and reduce the amount of double counting. Next, let's go on to customs duty and octroi. Customs duties and octroi are basically the same thing but at different levels. Customs duty applies for international transactions, so international goods, and octroi refers to statewide transactions or statewide trading. Now, what customs duty basically means is that when you buy an item from abroad, suppose I bought a PS5 from America. Now, when I buy the PS5, it will come here, but I have to pay a certain customs duty. This customs duty is to pay for the various taxes incurred during the shipping product incurred by the product from abroad. Now, when it arrives in India, it reaches a different state, and when it is sold to me by that different state, then I have to pay octroi. This is for statewide taxes that are applied throughout. Now, you understand? Now, have you got a general idea? That is, customs duty is paid for buying things from abroad to pay for taxes of that country, and octroi is paid from buying things from another state to pay for different tax rates in that state. That's all. Next, let's go into excise duty. Excise duty is basically tax that is applied on all products that is produced within India. That is, when you sell, octroi might be applied to it, but excise duty will be applicable for all products. Meaning, it is basically a customs duty for Indian products that is to be paid by all people who buy our products from other countries. Basically, excise duty is what other people have to pay for buying Indian products. That's all. It's simple, right? Next, let's go into tax incidence. Tax incidence is basically as follows. Now, what tax incidence basically means is the division of upon a percentage of tax paid by buyers or and sellers on a certain product. Now, when suppose we buy something, we have to, there's sales tax added to it, right? Sales tax is divided among the buyer and seller. When a certain percentage is paid by the buyer, a certain percentage is paid by a seller. Now, this certain division of percentage is known as tax incidence. Now, tax incidence can be decided based on the elasticity of demand and supply. That is, if supply is more elastic than demand, that is, supply varies more than demand, then the buyers will pay a larger percentage of the tax. And if demand is more elastic than supply, that is, supply is steady, but demand is less or varies, then the sellers will pay more of the tax percentage, and the tax incidence will be towards the sellers. This is basically about tax incidence. With this, we have covered the basics of taxes. Thank you and have a nice day.